In this podcast, I'm going to break down the market setup as we head into the first round of earnings and how the market might respond if the AI trade fails to deliver. Look, in the fast-paced world of technology, nothing seems more promising or more perilous than the rise of artificial intelligence. As hyperscalers pour billions into building out infrastructure, investors are left wondering when the baton will pass to AI enablers who can justify these enormous expenditures. Fear, in all its forms, drives human behavior. Why should it be any different in the world of investing? For some, it's fear of losing money. And when it comes to stocks like Nvidia, it's fear of losing profits. There are a lot of valid reasons to take profits or reduce exposure in front of what will be a very important earnings season, especially on the heels of a tech sector up 21%, inside a market up north of 17%. But let's at least be honest about it. Our biggest fear is that we'll give it all back to the house. Welcome to The Money Runner. I'm David Nelson. The AI trade is at the heart of this, so let's start there. The fear of AI isn't that services and applications won't be born from this rollout. Will they arrive in a time frame that justifies current valuations and price momentum? Much of the innovation will come from mega-cap giants like Microsoft, Alphabet, Meta, and a handful of other large-cap heavyweights. Venture capital is flowing into startups aiming to become the next OpenAI. By definition, most will fail, but a few will produce groundbreaking products that secure their place as must-own technology securities. Nvidia's continued success is closely tied to the success or failure of these giants, as its top 6 customers represent more than half its revenue. However, the true promise of AI comes from the thousands of companies that can use it to transform their business models. The critical question for every CEO: will the financial benefits justify the capital invested? The delicate balance of demand and supply drives price. It's been that way since the beginning of time. We don't yet have enough data on the revenue or margin boost early adopters will generate. Once this information is available, demand and pricing will adjust. This uncertainty is the biggest risk investors face. AI-related stocks have driven the bulk of investor returns over the last year, making the risks tangible. This doesn't mean we shouldn't take them, but it does mean we need a plan B. Earnings season is about to kick off with major banks like JP Morgan, Citigroup, and Wells Fargo reporting on Friday. While the next few weeks will be important for gauging investor sentiment and taking the pulse of the U.S. economy, the real action starts in the last week of July. Several of the Mag 7, including Apple, Microsoft, Amazon, Meta, and Alphabet, will report them. Nvidia, central to the AI trade, reports in mid-August. I put this in a post at least once a quarter, but it bears repeating. An earnings report isn't just a snapshot of a company's current health. It's also a report card on analyst accuracy. Over the past year, analysts have struggled to keep up, but this time, I believe they're closer to getting the numbers right. The risk is we may not see the blowout earnings and revenue beats of last quarter. And there's a bigger risk that analysts, in their effort to be accurate, might set estimates too high, leading to a negative surprise. What if Nvidia misses estimates? Well, if Nvidia misses revenue expectations by 5%, it would still bring in around $27 billion for its fiscal second quarter, $1 billion more than last quarter, and 100% higher than the same period last year. While this wouldn't be catastrophic, it would likely cause a significant market reaction, potentially leading to a 10 to 25% decline in the stock. What would that mean for the market? Well, let's do the math. Nvidia currently represents about 6.5% of the S&P 500. A 15% drop in its stock would drag the index down by about 100 basis points. If the rest of the tech sector declined by 3%, that would add another 100 basis points of downside. A similar decline in the communications sector, dominated by Meta and Alphabet, would mean an additional 20 to 30 basis points. All in, it could potentially deliver a better than 2% one-day decline many investors fear is long overdue. The rest of the market might not suffer as much. In fact, sectors like consumer staples and healthcare might end the day higher, seen as defensive trades. Other asset classes such as bonds, small and mid-cap stocks might attract investment as capital seeks new opportunities, especially in trades that have lagged behind market cap-weighted indices heavily influenced by the AI trade. In other words, capital will find a home. This scenario is speculative, but it outlines a possible path to a market reset that could sustain the bull market and direct capital to other vital areas of our economy. What should tech investors do the day after? For many, it will be an opportunity to hop on a train that left the station more than a year ago. For others, it will mean adjusting position sizes rather than eliminating positions altogether, as the AI revolution is far from over. We are still some distance from the point where the demand curve shifts from hyperscalers to AI enablers and end users. For now, we must navigate this transition carefully, balancing the promise of AI and with it, the inherent risks. Well, that's it for today. I'm out of time. But if you'd like to keep in touch, hit subscribe here and also visit my Substack site for a lot of extras. DCNelson123 at substack.com. This is The Money Runner. I'm David Nelson.